Welcome, guys. Let me just let everybody in so that we've got a full house. Brilliant turnout, everybody. 15 people and a few more on the way because they have just messaged me. I hope everybody has had an absolutely tremendous day, be that at work, be that having the day off, whatever you got up to. Tonight, we have got an absolutely amazing guest to come and speak to us about the macro influence. Dylan, please don't shoot me if I butcher this, but the macro influences on the crypto market, which determine whether or not the price of crypto is going to go up or down. And yeah, in relation to the macroeconomic picture and what stocks are going to do next, what bonds are going to do next, bond yields, etc., etc. Dylan is going to shed some light on this mysterious world, and that's its interaction between legacy markets and crypto. So I'm going to do minimal talking tonight. Dylan is going to take the reins. And on that note, over to you, Dylan. How are you today? Would you like to introduce yourself to the group?
Yeah, man, appreciate the very kind introduction. You big me up too much there. I think got a lot to live, got a lot to live
Never,
up,
never.
got a lot, got a lot to live up to now. I've been involved in kind of financial markets since around about, let's say, 2016, probably. I kind of caught the, let's say, second half of the bull run in 2016, 17. And kind of after that bull run, I kind of started spreading my wings a little bit more and kind of starting to understand macro as a wider topic, and kind of how crypto influences that and how macro obviously influences crypto. And yeah, like you said, I'm working with someone you had on your kind of webinar a few weeks ago, Neil, I believe his name was. I work quite closely with him, and kind of on the kind of fund side of things. And I'll leave it there. I don't want to kind of disclose too much more information, but yeah, I'm excited to do this for you guys and kind of shed some light on the macro picture. I think it could be very useful. There's a lot of valuable information. And it'll give you a real insight into what's actually going on in global financial markets right now. I think there's a lot of smoke and mirrors out there in the news and kind of what you see day to day, but there's something a lot deeper going on, which I think will be quite useful for you all to understand.
That's awesome. Can't wait to watch. And for anybody who has seen webinar number 3 of the crypto course itself, this is specifically what we address in that webinar. So Dylan is in a way going to complement that webinar and build upon the knowledge dispensed within it. So without further ado, I think we're good to go. Dylan, I
Yeah,
am
man.
going to go ahead and mute myself and I'll let you share your screen and we'll
Sweet.
crack on with this presentation. Looking forward to it.
Sweet, bro. Give me one sec. Can you guys all see that? Yeah? Give me a thumbs up if you can. Sweet. Love it. All right. Lovely. I'll get rid of all your faces, even though they're as beautiful as they are.
That's a good idea, actually, Dylan, because it shows up on the presentation. Otherwise, let me.
Yeah.
Did it just disappear then when I clicked that?
Do whatever you did again.
There. No.
Nah.
Tell you what. Can you see? There's a little minimize button just at the top of the when you can see where you can see everyone's faces. There's a
Yeah.
little minimize tab. If you hit that, then it'll get off the screen.
Got you. There you go. I'll just put that to the side. Is that all right?
Yeah, that's great. No, cheers.
Sweet. Right, guys. Macro sessions. This is it. Let's just jump straight into it. Yeah, so let's just go through the agenda quickly. I'm going to give a rough kind of definition of what macro actually is, because I think there's a lot of misconceptions about what it is and what it means, et cetera, et cetera. The fundamentals, I'm going to kind of go through the different data points that I look at within the macro world to kind of form my bigger picture perspective thesis of what's kind of going on. The components of macro, this is where I'm going to kind of detail which asset classes I look at in particularly. So obviously crypto is one of them, but you obviously got to look at the dollar, equities, bonds, things like that. So I'm going to go into a little bit more about them and kind of what they mean, what they are, and how you can track them. I'm going to go into the correlations, what we're all here for, and how crypto fits into the big macro world and things like that. And then at the end of it, I'm just going to kind of go through my current thesis of what the current macro backdrop is, what it means, what's going to happen over the next kind of 12 months, et cetera, et cetera. So like I said, what is macro? Whenever anyone asks me this, really, I kind of struggle to come up with a definition because A lot of retail traders generally, when you come into like the forex market or things like that, you're always told that news means nothing, fundamentals mean nothing, and charts and technical analysis is all you really need to know, because they tell you the truth. Whatever happens on the charts is pretty much all you need to know. And to an extent, that's kind of true, but markets move on narratives. That's rule number one. Markets always move on narratives, and you only need to go back to COVID, March 2020, to understand that, right? What was the narrative? Pandemic. What happened? Markets sold off. Every single market sold off, right? And yeah, that was a kind of one-off kind of black swan event, but markets move on narratives. That is so, so key to understand. And if you can understand the narrative, you can position yourself very well as a long-term investor going forward. If you don't understand the narrative and you want to just be trading day to day, that's fine. But if you want to really be successful over a long period, 5, 10, 15 years, make sure you understand the narrative of what's really going on, and you can position yourself best that way. So fundamentals, what's the kind of economic data that I look at to kind of form my thesis? As I've put there, economic data is key to understanding the global landscape. So the first thing I would look at is GDP, which I'm sure everyone kind of knows what that is. So GDP is super important. Retail sales, that's another kind of key economic data point that I tend to look at, because it really gives a good kind of sentiment from a consumer perspective, right? How they're feeling. Do they have confidence in the economy? If you take the United States, for example, around about 70% of retail sales is what makes up GDP. So that's a really strong indicator to understand whether economy is weak or whether it's strong. CPI and PPI, those are your two inflation metrics. So CPI is your consumer price index. This is telling you the kind of rate of change for how much consumers are paying for their goods and services. PPI is the producer price index. So this is telling you what producers and manufacturers are paying to produce and create those goods and services. Unemployment, that is a huge one, especially right at the moment after COVID, where we saw huge amounts of job losses. Unemployment's massive because the more people you have employed within a society, within an economy, there's more money that's going to be kind of transacted and flowing throughout that society. So that's important. If you've got strong employment within your economy, then that's good for economic growth. Central banks. Now, that's going to be a theme which my kind of whole macro thesis is based off, central banks. And they're kind of a key pillar as to what's going on right now. And not a lot of people really understand it. So I'm going to kind of go into that a little bit more later on. And hopefully you kind of take some good nuggets away. And I've just mentioned there at the bottom, US, China, Europe, and Japan. These are known as the G4 central banks. So the big four, basically. US and China, they're the two largest economies in the world. Europe, again, absolutely huge, and Japan as well. So the components of macro, what kind of asset classes am I looking at? What do I look at to form my thesis, right? But before I go into that, I just want to kind of mention this risk on, risk off kind of thing. If you're a day trader, whatever you do, you trade crypto on a day-to-day basis, you're a long-term investor, whatever it is, whenever you come to the markets on a Monday morning, Tuesday morning, whatever it is, you need to understand the risk sentiment. Are we in a risk-on environment or are we in a risk-off environment? So for the last year, global markets have been in a risk-on kind of sentiment. So all that means is in a risk-on sentiment, you have the dollar going down because people don't want to hold cash. You have bond yields going down because they're no longer attractive because the yields that you're getting on bonds are currently around about 1.2, 1.3%. Equities go up and Bitcoin goes up. Now, a lot of people say to me that Bitcoin is this uncorrelated asset class. It's an inflation hedge. And I'm like, no, it isn't. It's a risk on asset. That's how it behaves, right? If it was an uncorrelated asset class, Bitcoin wouldn't have dropped 50% in March 2020, right? Bitcoin moves alongside equities. It's a risk on asset on a day-to-day perspective. If you want to zoom out from the bigger picture perspective, yeah, Bitcoin's an inflation hedge because it's outperforming the rate of inflation. So from that perspective, yes, it's an inflation hedge. But if you're looking on a short-term day-to-day perspective, I view Bitcoin as a risk on asset, right? So risk on is good. Risk on means markets are moving up, everything's going up, everything's good. Risk off is the total opposite. So risk off is what we saw in March 2020. So this is where the dollar goes up because there's a flight to safety of cash. People want to hold cash. Bond yields go up because they become more attractive. Equities go down and Bitcoin goes down. They go down together. So let's start with the dollar. As you all kind of know, you may have kind of heard of, the dollar is the world's reserve currency. So what does that really mean? What is a reserve currency? So countries, they will hold not only their currency, but they will hold other currencies on their balance sheet as reserves. Now, this is just as security, just in case anything goes wrong with their local currency. Let's take Venezuela, for example. They've got hyperinflation. If anything goes seriously wrong with their currency, they have reserves. They have backup, basically. So a lot of countries will hold significant amount of dollars in reserves, just in case anything goes wrong. They're able to transact with dollars freely globally because dollars, as everyone knows, if you go to any country abroad, majority of people will take dollars. It's a safe haven asset, like I mentioned in my previous slide. Whenever there's kind of that kind of risk off sentiment, people tend to flood and hold cash because it's safe, right? The wrecking ball. So I tend to call the dollar the wrecking ball because when we're in that risk off scenario, when the dollar's going up quite strongly and aggressively, it's a wrecking ball for other assets. Equities go down, stocks go down, Bitcoin goes down, crypto goes down, everything goes down. So it's a wrecking ball in that kind of sense. And another kind of interesting fact, which you all probably might have come across, is 25% of all dollars in circulation right now were actually printed in 2020. So that's absolutely fucking mind blowing for me. So this is a chart that I've put on. And as I mentioned, markets move on narratives. So this is a chart of the dollar from 1986 to 2022. And these are the different narratives that were in play at the time. So if I just show you here, this was the Federal Reserve raising interest rates. So whenever interest rates go up, that's good for the local currency because you're getting better interest rates on your savings accounts in banks, and it becomes a little bit more attractive to hold currencies, right? You can see here in 2000 when the dot-com bubble burst, when when tech stocks were going up, everything was going up. This was the dot-com bubble. Once that bubble bursted, dollar went down because the dollar should have gone up there because it should have acted as a risk off kind of as a sentiment, and people should have flooded towards the dollar, but people actually went into gold instead. And I'll show you that on the next slide. And there's a couple of others here I could go through, but I'm not going to waste your time. I'd rather kind of just get through the next slides. But you can see everything kind of moves on narratives. These currencies, assets, they move on narratives. And this is just kind of what I was talking about just before. This is gold. So as you can see here, the dollar dot-com bubble burst, the dollar kind of plummeted. And the next slide, you can see around about that same time in 2000, gold went on its first real historic bull run, which was epic. So bond yields. I personally love bond yields. I think it's an incredible asset class. It tells you a lot about what's going on in an economy, whereas certain asset classes like equities, you can get a little bit caught up in because they just go up every day. They don't tell you really what's going on. And I tend to say to people, ignore all noise in the market, ignore the equity market, ignore the dollar to an extent. Just focus on the bond market and what it's really telling you, because it's the voice of reason. Right? Why is it the voice of reason? Because the people who invest in the bond market aren't your average Joe off the street. They aren't your retail investor. These are institutional people who have significant amounts of capital, to invest in the market. So you get two types of bonds. You get government bonds and you can get corporate bonds. So with government bonds, let's just take the US, for example, you have short-term bonds like the US 2-year, the US 5-year, and then your long-term bonds are more the US 10-year and US 30-year. So all this means is if you're getting a better return on your 10-year and 30-year bond versus your 2-year and 5-year bond, that's telling you that investors are optimistic on the long term of the US economy versus the short term of the US economy. So if you were getting a better yield on your short term bonds than you were on the long term bonds, that's telling you the opposite, that people are more optimistic on the short term than they are on the long term. Now, corporate bonds, the best example I can give you of this is MicroStrategy. And I'm sure you've all heard of MicroStrategy. They've bought up every single fucking Bitcoin probably there is in existence at the moment. And what they did recently to buy their most recent Bitcoin was float I think it was $400 million in the junk bond market. So the way that works is they'll want to raise $400 million in the bond market. They'll attract a certain number of investors who will give them cash to buy their Bitcoin with. And in return, MicroStrategy will give them a bond, aka let's just call it a voucher. So I believe it's every year or every 6 months, MicroStrategy will have to pay that investor yield on that bond. So I believe they're paying them around about 6 to 7% on that. So in a way, these investors are actually getting indirect exposure to crypto through this kind of bond raising that MicroStrategy have done. So it's an interesting play from them. But bonds usually move on interest rates. They usually move on inflation expectations and economic growth. Now I can talk about a little bit more about that. I'm just going to shift over to TradingView on the charts and kind of show you a little bit better. So I said bond yields generally move on interest rates. So what the central bank, the US Federal Reserve, did when COVID hit was they lowered interest rates. Whenever there's a recession or anything like that, or anything of that magnitude, central banks will usually, first thing they'll do is reduce interest rates. Why? Because that forces cash out of the system, out of banks, and it forces it into the markets, which is what they want. So you can see here, interest rates went down, bond yields plummeted, right? This was March 2020, round about here. Bond yields plummeted. And I say they're the voice of reason because from March 2020 onwards, every single asset class on this planet went up. But what did the bond market do? It did nothing. It did absolutely nothing. It went sideways. It went sideways for pretty much the entire year. Why is that? Why are bond markets moving? Because they're the voice of reason. They don't get excited like the equity market does. They don't just go up like the equity market. It's more of a mature asset class to be investing in. It tells you the truth. So towards the end of kind of 2020 to the beginning of this year, I'm sure you've all seen over the last couple of months, inflation has been red hot and it's been in the headlines. So that's the reason why bond yields were going up, because inflation expectations were on the rise and people were getting a little bit excited. And then what happened here? March 2021, bond yields went down when inflation was supposed to be going up. What does that tell you? Interesting. I'll touch on that a little bit later as well, and I'll use gold as the kind of example of that as well. So that's bond yields. So this is a chart actually of bond yields from kind of inception, and the grey kind of the grey little shadows that you can see in the background, that kind of highlights every recession we've seen over the years. So you can see in the 1970s we had red hot inflation, actually the highest we've ever seen, and bond yields, your return on the US 10-year bond yield was actually around about close to 16%, which is insane. Absolutely insane if you think about it now. And what happened around that time was the chairman of the Federal Reserve at that time, he committed to lowering inflation and lowering prices. So that kind of sent bond yields tumbling. But a really, really interesting chart just to look at from a bigger perspective kind of thinking, because bond yields, they're in this huge, huge downtrend now. And to be honest with you, from my perspective, I don't ever really see bond yields ever hitting 4% or 6% or 8% ever again. These things are going to stay at record low levels, and it's going to induce investors to take on more risk in markets and kind of go to the equity market, explore alternative asset classes like cryptocurrency and things like that. So yeah, this is interesting. FX market. I don't know if any of you do kind of dabble in the FX market, but it's quite a good risk indicator just to kind of take note of, really. Like I said, when the dollar goes up, it's risk off. Same with the yen, Japanese yen, and the Swiss franc as well. When these kind of currencies tend to go up, it means we're in a kind of risk-off scenario. When you see the pound, the euro, the Australian dollar, and the New Zealand dollar going up, this is generally risk-on. So yeah, it's always just. I don't really pay too much attention to the forex market, but now and again, I'll just kind of flip my screen to it just to see what the sentiment is like, and it's just another good confluence to have in markets, I'd say. So the equity market, everyone's favorite kind of little toy to play with. I don't tend to trade the equity market. I pay attention to it, definitely, but it's very heavily manipulated. The kind of three main ones I look at, you can look at the FTSE 100 or whatever it is in the UK, but the main ones to look at are the US equity market, which is the S&P 500, which is 500 of the largest US companies, the Dow Jones, which is 30 of the largest US companies, I believe, and the NASDAQ, which is just your tech index, so 100 of the largest kind of US tech companies there is. And equities are generally driven by, well, you could say all markets are, but equity markets especially are driven largely by human behavior. And monetary and fiscal stimulus, of course, which, like I said, I'll get onto a little bit later. But generally, I like to refer to the equity market as the kind of, if the dollar and bonds are like the king and queen of the kind of like of the chessboard, the equities are probably like the pawn, right? They're probably like the little child in this whole kind of this game. Another kind of interesting stat is that over 35% of US households are actually invested in the equity market. So that gives kind of the Federal Reserve central bankers reason to prop up these markets, because if the equity market was to plummet, like let's say like crypto did 50%, the whole bloody society, the whole kind of the United States would be in turmoil, right? So that gives them that little bit of incentive to kind of keep these markets propped up. So this, again, just a nice little chart just to kind of indicate to you household allocation to equities. It's just gone above around about 35% now, which is insane. Now, this is a chart of the three equity markets. I just kind of the three kind of equity markets I was just mentioning to you before. So in the blue, we've got the Nasdaq, which is tech, S&P 500 in the orange, and the Dow Jones. So you can see these markets don't tend to go down a lot. They have short, sharp corrections along the way, but because they are so influenced by human behavior and have such large influence from central banks, they just tend to go up in exponential trends. If you're short on the equity market, I feel sorry for you. Yeah, so this is what I was just talking about just then. The equity market is very heavily influenced by central banks and fiscal and monetary stimulus. So all that central banks do when they pump money into the markets and print money, all they're doing is providing liquidity. Most recessions are caused by a lack of liquidity, and liquidity is just buying and selling, basically, right? So you can see how correlated the S&P 500 actually is with global liquidity. So, and you can even see just at the top there, when liquidity kind of took a turn down south, the S&P 500 actually followed it as well. So I believe once central banks start pulling back on the amount of money they're providing to economies to stimulate markets, you're going to see equity markets come lower. You're going to see crypto come lower. So this is quite important to kind of take note of. So the big question: how does crypto fit into this environment, and what kind of correlation does crypto have to these other asset classes? Now it's quite interesting actually, because if you look at back to 2013. Bitcoin had a negative correlation to a lot of these asset classes. So you look at the S&P 500, US bonds, gold, real estate, oil, emerging market currencies. They had a negative correlation. But moving into 2020, these things have actually started moving into positive correlation territory, which is very interesting. Now, is that because we're seeing more institutional attention to Bitcoin? Is that because a lot of money that was parked in these other asset classes, like I said, equities, bonds, et cetera, is now moving into crypto? Is that the reason? Could be. Or is it because central banks are just printing money and stimulating markets to the point that no asset class will go down? Could be that as well. So for me, like I said at the beginning of this, Bitcoin will act as a risk-on asset in your portfolio, right? It won't act as that kind of uncorrelated hedge. It won't act as that inflation hedge. Over a 5 to 10 year horizon, yes, it will. But on a day-to-day perspective, not so much. So what's the current macro backdrop? What's actually going on right now after all that I've just kind of showed you there, basically? So I want to start with the business cycle. So all kind of countries, markets, everything, they move in a cycle, right? And this is the business cycle generally. So they move in 4 phases. So you've got the early part of the cycle, the mid part of the cycle, the late part of the cycle, and recession. So if we take March 2020 as the recession and we kind of restarted this business cycle once again, then here we are right now. So you can see China. The reason I mentioned China at the beginning of the presentation is because they tend to lead the business cycle. So China is a really good barometer of strength of just global strength in countries and everywhere. If China is doing well, everything else will tend to do well. If China's slowing down, then that's a bit of a warning sign and a bit of a red light. You need to start paying attention. So at the moment, you can see we're at the mid part of the cycle. China's entering that mid part of the cycle where growth starts to peak, profit growth starts to peak, central bank policy is neutral, and inventories, sales grow, and equilibrium is essentially reached. In the early part of the cycle, which is what we were seeing, let's say, last summer, early this year, you're going to see activity rebound. GDP numbers were through the roof, right? Profits were growing. Companies were doing really, really well. And the optimism was strong, right? Now we're entering this mid part of the cycle. We got to be a bit wary. Is growth going to start to peak? I'm seeing that at the moment, and I'm going to show you what I'm seeing in the slides to come. But growth is potentially starting to peak. China is beginning to slow down. We've got the Delta variant starting to arise again, which is prompting a bit of concerns whether we're going to see another March 2020 event. In my opinion, I don't think it comes to that extent, but we still got to take this into account. So like I said, China leads the business cycle. This is the China credit impulse. Now, this is super important because it's a really good indicator as to whether the Chinese economy is strengthening or slowing down. China credit impulse has actually gone negative now. So that's a really strong indicator for me to start paying attention and looking at, okay, are we starting to slow down as an economy? Is there certain things I need to pay attention to? Do I need to take risk off the table? Let's look at inflation. So like I said, remember in the 1970s, we had record high inflation over here. Inflation is still high at the moment, But like I said, what's the bond market telling us? What's the bond market telling us about inflation? Ever since we hit that peak in March 2021, bond yields have actually gone down. So that's telling us the market isn't pricing in inflation, it's pricing in something else. Remember, bond yields move on interest rates, inflation, and economic growth. So we know interest rates aren't rising. Interest rates aren't going lower because they're already at their floor. We know bond yields are going down, so inflation isn't on the rise. And so what is it then? That's the third one, economic growth. Is economic growth slower than we anticipate? Could be. Let's have a look. So this is a chart of the bond yields, like I said, over time. And all that arrow is pointing to is what we've seen in previous recessions. So that gray kind of bar that's in there in the background again, that's every single recession we've seen. So obviously the dot-com bubble in 2000, 2008 financial crisis, and 2020, obviously COVID. So that arrow, all that's pointing to is when bond yields have risen after a recession. That's people getting excited. People are excited because economic growth is going to get back to what it was before. Inflation is going to start running hot. Interest rates are going to start getting risen again, and everything's going to be hunky dory. Not the case. People get a bit excited, and what happens? Bond yields roll over. What happened here? They started rising again. Everyone got a bit excited. They rolled over. Same thing here, and the same thing is happening yet again here. This is the dollar, the DXY, the dollar index. So just to kind of as a perfect example as to what I was talking about before, when we had the COVID crash, you can see the dollar absolutely flew in value over a period of 2 weeks because people were moving to cash, people were moving to that safety. But once central banks turned on the money printer, what happened? The value of the dollar eroded away very slowly. But what we're seeing now is the dollar starting to gain a little bit of strength, and it's alongside bond yields and China and everything that's going on. It's giving me a sense of something's going on, which maybe the market's not prepared for. This is the Federal Reserve balance sheet. So this is super, super important to kind of look at. And like I was saying, this is kind of whenever the Federal Reserve does quantitative easing, which is the kind of process of printing money, what they actually do is they don't just print money and kind of chuck it in the air. They will buy bond yields. So by buying bond yields, you're suppressing the yield and you're forcing investors to go outside the curve. Like I mentioned, when bond yields are going down, it forces investors to step outside of the risk curve, go into alternative asset classes like crypto, equity, stocks, tech, GameStop, things like that. So what they do is at the moment, the Federal Reserve are buying $120 billion of bond yields every single month, and they're putting that on their balance sheet. The Federal Reserve's balance sheet right now is equivalent to around about $8 trillion, which is, I believe, 36% of their GDP, which is insane. The Bank of England, their balance sheet, I'm not sure what it sits at, but it's around about similar, around about 30% of GDP. And Japan, which is the most insane, the Bank of Japan, their balance sheet sits at around about 110% equivalent of their GDP. So yeah, crazy. Again, yeah, this is the ECB balance sheet, the kind of Eurozone, sitting at 7 trillion, insane. These are just normal numbers. You can see here, actually, like from 2008, once we had the first financial crisis, they started easing, they started buying bonds, they started quantitative easing, and that slowly increased more and more over the years. But once COVID hit, they just hit the accelerator on this. And I say to people all the time, we're living in unprecedented times right now. There hasn't been a period of time in history where markets have really been influenced by central banks, and central banks have had to take such a stance and really kind of control markets to that extent. So it's there's opportunity in it because there's a lot of money to be made, but it's scary at the same time. So this is velocity of money M2 stock. So all this is really is telling you how much money is kind of flowing throughout the system, is being transacted throughout the system. So with velocity of money being at record level lows, all that's saying is there's not a lot of money moving throughout society, moving throughout the system. It's being hoarded. It's being hoarded in people's savings accounts. It's being hoarded in, institutions are hoarding cash right now. I know JP Morgan just recently came out and said they're holding a significant amount of cash on their balance sheet right now. I don't know whether they're seeing something similar to me with growth kind of tapering maybe a little bit. I don't know what it is, but it just means that a lot of people are hoarding cash and they're not spending it. And all that means is we're just continuously going round and round in this circle. People aren't spending their money, so central banks continue to have to kind of print more money to stimulate economies. So it's just this merry-go-round that we constantly go on. US unemployment. I mentioned unemployment is a massive thing to look at. So one thing to mention is central banks, when they when they approach markets, they have a mandate to adhere to. And the two things on that mandate is employment. They need to make sure employment is strong, and they need to ensure of price stability. So that takes in inflation and kind of price stability in terms of markets as well. So unemployment actually hit like crazy levels during COVID. So we went to around about 15%, I believe it was. That's come down a hell of a lot, but we're still not at pre-pandemic levels. And what the central banks have actually said is, until we come back down to those pre-pandemic levels, we are going to continue to stimulate economies. We're going to continue to stimulate by printing money. So that's good in a sense, because we're going to continue to see markets rip higher if that's the case. Again, this is initial jobless claims. So these are the amount of people every week. So this data comes out on a Thursday. If you're from the UK, this comes out on a Thursday at 1:30 p.m. in the US. And you can see during COVID, 6 million people claimed for jobless benefits, at the height of COVID. That's, again, significantly come down, but again, still not at pre-pandemic levels. This is interesting. So this is actually showing you job openings in the US. So we've got currently around about 9 million. I think the print this week was 10 million. So this is slightly old, but let's just say 9 million for the sake of this chart. 9 million job openings in the US. However, the amount of people claiming pandemic unemployment benefits sits at 11 million. So that tells you that we've got an unmotivated labor force here, right? Like, you've got 9 million job openings, yet 11 million people are still claiming benefits. Why is that? Is it because of COVID? People are scared to get out and, face the world, It could be that. It very well could be that. But this to me just says that the Federal Reserve, the central banks, not only are they doing monetary stimulus, which is, like I said, printing money and buying bonds, but they're doing fiscal stimulus as well. So obviously in the UK, that's known as furlough. In the US, they were sending stimulus checks out every month, so people didn't have to work. They were getting paid more from the government than they actually were in their jobs. So if you're in that position, would you want to go back to work, or would you just be happy claiming $2,000 a month? I don't know what I'd be doing. So yeah, a lot of these benefits actually roll off in September in the US. So it'll be actually interesting to see if this number changes. This is another interesting one to do with employment: labor force participation rate. So how many people are actually participating in the labor force? So yeah, we've got these two metrics here, unemployment and initial jobless claims, which have come down significantly from the highs of COVID. However, the labor force participation rate hasn't really done anything, has it? It's just sitting around those eerie levels around about 60, 61 and a half, 62 even. So yeah, we've got an unmotivated labor force at the moment, which doesn't bode well. So finally, I think this is going to kind of be the most interesting part, and it'll probably kind of make you scratch your head a little bit. So this is, like I said, the G4 central bank balance sheet going exponential over 2020. Now, in crypto, I don't know whether you might have taught this, James, or not, but you can look at Bitcoin. And when it comes to looking at the altcoin market, we look at alt-Bitcoin pairs. So we look at the strength of a certain altcoin versus Bitcoin. Now, all I'm going to do here now is, by showing you this, is compare all the assets that I've just shown you. So bonds, equities, gold, and Bitcoin. We're going to compare it against the central bank balance sheet, because now it's no longer worthy you investing in the S&P 500 and getting 13% a year. You need to now start beating the rate of inflation. Otherwise, you're going to be eroding your money away month after month, year on year. So now you need to actually start beating the G4 central bank balance sheet. That's what you're up against now, right? So let's have a look at TLT, which is bonds. Bonds versus the central bank balance sheet. How strong are bonds versus the central bank balance sheet? And looking at that, not at all. They've been in a downtrend ever since 2006. So do we want to park our money in bonds? No. How about the S&P 500, the thing that only goes up? Ever since 2007, it's gone down. It's moved relatively sideways since 2008, but nothing really which screams, okay, maybe have a small allocation, but nothing that screams to me that I want to have a big allocation in the equity market. What about gold, the great inflation hedge? No, not done anything. In 2008, yes, it did do quite well. It kind of withstood the kind of the central bank balance sheet. But ever since 2011, it's just withered away. And 2020, when it should have stood up in probably the biggest crisis we've ever seen in our lifetimes, it's gone down. It did. I think it did well at the beginning, around about from March to August. I think it hit a new all-time high or something like that. But generally, gold has failed as an inflation hedge. What about Bitcoin? Well, that just looks like the Bitcoin USD chart, doesn't it? So Bitcoin is actually outpacing the rate of printing by the central bank balance sheet. And for me, it is, like I said, outpacing the rate of inflation over time, not on a day-to-day basis, but over time. And this for me is the asset that you need to be parked in and kind of have your exposure in, because it's gonna compound your money, not erode it away. So final thoughts. Remember, guys, the risk on, risk off. Like I said, if you want to, I'll go back to it. Oh, well, sorry, I'm sure you're probably going to video this and send it out afterwards. So remember the risk on, risk off on the previous slide that I mentioned. Remember the correlations, dollar and bonds. They're your king and your queen. Always look at the dollar and the bonds for kind of a sentiment check as to what's going on. And remember, central banks are the key pillar in what's going on right now. This should tell you everything you need to know about what's going on in markets right now. And the Fed are just literally, it's insane what they're doing right now. I have no words. And even economists who are much better than me and much more respected than me, I don't think I'm that respected. I'm just a normal guy. But yeah, people like that are wary of what's going on, and they're almost not scared, but it's just like, wow, we're really living in crazy times right now. It's not just COVID we've got going on, but we're like the central banks, right? It's insane. So guys, I hope you kind of took away something from that, and appreciate James once again for letting me do this.
My absolute pleasure, my friend. Wow. Well, that was super interesting and riveting, and it did definitely build on what I said in my previous
Awesome.
webinars and lectures. Number 3, a lot of stuff that just tied in nicely with what I was saying. Thank you so much, Dilen, for that interesting presentation. We got a double thumbs up from Tim. Tim looks like he's impressed. Good stuff, Tim. Good to see you, my friend. Now we are going to fire over. Vihar's happy too. Nice one. Brilliant. Good to see your faces, everybody. What was I going to say? Now we are going to fire some, well, we're going to allow the floor, to fire some questions at Dilen about crypto, about the macro market, etc., etc. What I'm going to do, there's actually 2 questions that have been sent in beforehand. So let's go ahead and get those out of the way before I forget. And then I'll open things up to the floor. First question, Dilen. Let me just unpin myself because everybody wants to look at you, not me. You'll be doing the talking.
No, I don't want to look at my ugly. You don't want to look at my ugly face, mate.
What are you talking about? That's some brilliantly trimmed facial hair you got there. This designer facial hair. You're looking good, brother. What was I saying? Yeah. So the first question that was sent in with regards to bond yields. Bond yields are expressed as a percentage of the face value of the bond, right?
Yeah.
So as the bond price, surely if bond prices go up, that's a risk off environment because people are buying bonds, they're buying them up, right?
Mm-hmm.
Wouldn't bond yields go down because as a percentage, the yield is less than the face value? Do you see what I mean? How does that work?
But
how does that work?
It's an interesting dichotomy between the two, but all you got to kind of look at it as is, like I said, it's all reliant on central banks. I'm just going to keep going back to that because it's all it is. Central banks are buying bonds, so that's reducing the yield that you're getting. It's difficult to explain.
So the price goes up, therefore the yield goes down.
The yield goes down. Exactly, that's how it works. So, like I said, the reason why they're buying these bonds are to incentivize investors to move out of the risk curve and park their money elsewhere. If bond yields are going up, that makes it more attractive, and investors will park their money because you got to think from an institutional standpoint. If you've got billions and billions of dollars, you're not going to just park that in Bitcoin. You got to be a bit smarter with it. So you're going to park a certain allocation into bond yields, and you're going to park a certain allocation into cash, and then you're going to have your equity market. You're going to have allocation to equities and crypto, etc., etc. But yeah, record when bond yields are low, just know that risk is on.
Right, I see. That makes more sense now. So when risk is off, bond yields go up.
Yeah.
And that makes them a more attractive investment prospect.
Yeah.
Right, get that now. Cool. And there was just some more questions that were fired in before we started. So let me just go ahead and look those up. Here they are. And actually, these are some really good questions because I anticipate that some people on this webinar might have, will likely ask these tonight. So Dilen, anonymous question, what are your thoughts regarding the infrastructure bill in the US and its potential impact on DeFi and the space in general? You'll no doubt know about that. There was a few developments on that today. For anybody who doesn't know, there's a few people in the crypto world are sweating, I suppose, at the minute. There is a infrastructure bill that is going through the tiers of government in the US Capitol that may impinge upon people's ability to mine crypto. There is speculation, at least it's not definitive. Dylan will do a better job of describing it than me.
Yeah, I've been keeping up with it briefly, very briefly. I've had a lot on my plate recently, but yeah, I was keeping up with the infrastructure bill today. I believe it got passed. I was looking at an article. Just give me one sec. I'll literally find it just to see if it's.
Yeah, cool, no problem.
Yeah, U.S. Senate passes 1.2 trillion infrastructure bill in 69 to 30 vote. So yeah, pretty much a majority vote. I believe I don't. I'm not sure if that's the crypto one or the other one.
Hmm.
1.2 trillion. I believe that's the one. But yeah, it's the problem with the infrastructure bill is the language that's used in it, and it's very broad. So with crypto right now, it needs proper regulation. And what's going on is you've got a bunch of, and I don't mean to seem rude because you've got probably quite a few elderly people in here as well, but you've got a bunch of like economists and senators who know nothing about crypto, right? And they're trying to regulate this market, right? And they're using language which, like I said, is very broad. And when it comes to like brokers and exchanges, um, kind of doing business and kind of moving forward, it makes that very difficult for them to do. So, yeah, I'm not sure how it's going to affect it, but at the moment, I believe it doesn't look like the market's too affected at all. And you could argue that the market already kind of priced this in with the drop that we saw 50% back in May and June. I know the kind of infrastructure bill wasn't kind of floated about back then, but in market terms, you could say it's been priced in already.
The great thing about crypto miners is they can move anywhere in the world, you know? So it's not,
Yeah,
I wouldn't be so, to the anonymous person who asked that question, if it does prove to be an issue, I would see it as only as a short term disruption on
yeah,
the long term Bitcoin going up because of the reasons that we said. At least those are our beliefs anyway. Dylan and
yeah.
myself. No one knows for sure. No one ever knows these things for sure. Cool. Do you read any? There's just two more of these questions, guys, and then I'm going to throw the microphone out to the floor. Dylan, do you read any other quarterly reports from other hedge funds, i.e., Pantera Capital, as part of your research?
Yeah. I get like I'm subscribed to a like an internal kind of newsletter kind of thing, and it kind of fires across like reports from different hedge funds and what they're kind of seeing. So yeah, Pantera is really good. I've definitely followed that. Dan Tapiero, I think he is the one who kind of runs Pantera Capital. Very respected investor. Another thing that I'm subscribed to is Real Vision. Raul Pal, who's a tremendous macro investor. I would suggest everyone go on YouTube. A lot of his content is free. So go onto YouTube, type in Raul Pal, Real Vision, and a lot of his content is really good. I've learned a lot from him. So yeah, I'd definitely point people towards that direction.
Here is a great question that someone sent in. Now, feel free to only say as much as you're at liberty, I suppose, to say on this one, Dylan, given the
Yeah,
sensitive
yeah.
nature of what you do. Great question, this is actually. What are the limitations of institutional trading compared with retail?
You've
Gotta
got you've got yeah.
be
You've
careful
got
with it,
more
don't we?
you've got all it is you've just got different parameters at play. With a retail account, you can go 100 times leverage, right, on some of these things like Binance and FTX and things like that. With an institutional platform, being an institutional kind of fund or running as an institution, you've got to kind of there's certain risk parameters in place because you're not dealing with your own money, you're dealing with other people's money. So you have to kind of take that into account. And there's certain more. I can't go too much into detail, but there's certain risk parameters in place which you kind of just have to adhere to.
One common one is the layers of bureaucracy. Like when you're a small fish or you're a retail investor,
Yeah.
you can move around a lot of money just with a few clicks of a button.
Hmm.
Whereas with large institutions, they're never going to be as agile as that. There's a board meeting that has to be held. There's layers of bureaucracy. I would
There's that
imagine
as well.
that's the case. I don't know how much you can say, Dylan, but I would imagine that's the case in every hedge fund.
That is the case, but like again, if we're just talking in simple buying and selling terms, if we just wanted to execute a sell or a buy just here and now, it can be done. But like you said, that if we wanted to make certain changes and do certain things, like yeah, there is certain things, certain hurdles you have to jump and bureaucracy in place which you have to get through.
So awesome, no problem. All right, we have a few questions in the DMs, but everybody's probably had enough of me talking by now because I've done a lot. So let's throw the microphone out to the floor and we'll come back to the questions in the DMs.
Yeah, sweet.
Would anybody like to raise their hand or just feel free to unmute themselves and ask Dylan anything they like? Anybody got any questions about the macro picture, or even just the Bitcoin
Yeah, yeah.
market in
Even just
general?
Bitcoin doesn't have to be macro. Even if it's just
Yeah,
Bitcoin, just fire it away.
yeah. I've got a few. If anybody,
Go on,
okay, if
mate.
anybody's thinking of any, feel free to put their hand up in just a second. I've got a few. Dylan, bullish or bearish in the next 3 months on Bitcoin?
Bullish, bullish,
Bullish,
very
yes. When do we see
bullish.
the end of this cycle?
I was expecting it to end towards the end of this year. But generally, what we see with Bitcoin, and I'm sure you've covered this as well, is lengthening cycles is a theme. Um, and if we get that lengthening, that cycle extension from here, then I believe we will move into Q1 2022, probably at some point. We maybe top out. Um, like I said, it depends on a lot of factors, a lot of macro factors as well. At the moment, because we're seeing strong economic growth from the US, the central bank is now talking about tapering, which means they're pulling back on how much money they're actually stimulating within the economy. Where if that goes through, I don't know how much of an effect that's going to have on the market or not, because like I showed in my presentation, markets are pretty much positively correlated with how much the central bank balance sheet. My thesis is that economic growth isn't as strong as it is, and central banks will eventually have to taper once again towards the end of this year. Instead of, sorry, not tapering, they will have to continue stimulating as opposed to tapering. If we look back at previous recessions, central banks have actually stimulated twice. So if we count March 2020 to now as one round of stimulus, central banks have usually done two. So we've still got another round to go, going off if we're going off historical data and historical kind of narratives and things like that. So yeah, I believe economic growth isn't as strong as people think it is. We've peaked essentially, I believe, a little bit. It doesn't mean we're going to go back into a recession and we're going to get minus 10% GDP or anything. It just means things are going to slow down a little bit. The foot's going to come off the accelerator, and that means that central banks will be forced to stimulate again.
That's awesome. With regards, everybody has their favorite bull market top signals.
Yeah.
Okay, one of my favorite is Google search trends. How many people are typing in buy Bitcoin?
Yeah, I
You
think that's a bit of it's a bit of like it only really counts for like
retail?
for retail and new users, right? Because
Yeah,
like for anyone in this call or me, I'm not going to go and type in buy Bitcoin on Google if I want to buy Bitcoin. I'm just going to go to my exchange and buy it.
yeah.
So it's not a very accurate one.
You
For
don't
bull
think
market,
so? It's
it's
if you
good.
look
It's
at
good.
it,
It
if
is
you look
good.
if you look at it, if you type in buy Bitcoin, Google search trends,
Yeah,
and you put the history back to 2005, you will see
yeah.
two peaks. Okay, one was in December 2013, and one was in December 2017. And it made all-time highs both times. But the reason I like it anyway. We digress slightly. The point of me saying that was I wanted to ask you about your favorite top signals. I'm gonna guess buy Bitcoin is not one of them.
No, it's not.
Google search trends, but I
Definitely
want to
not.
know
No.
what yours are. I want to know what yours are.
Uh, I use I tend to use on-chain metrics, which are really really good indicator as to what's going on. Like on-chain, I don't know if you've covered this. Have you covered this with your community before?
We have, yeah. It's in lecture 12 actually, but
Yeah.
yeah, I'd love to hear what
Um,
you say.
Yeah, so on-chain really, if you just the easy way to say it is really like an X-ray of the Bitcoin network, right? It really shows you what's going on deep beneath it. Um, and while the whole sell-off was going on and while we were kind of ranging between 30 and 40K, and everyone was super bearish, on-chain was actually showing that um, short-term holders were capitulating and selling, and all those coins that were being sold on the market were being scooped up by long-term holders, people who hold Bitcoin, who have wallet sizes of 100 to 1,000 Bitcoin in their wallets, right? Those were the kind of people that were scooping up Bitcoin during this kind of range bound price action that we had over the last 2 months. So that to me is super bullish, right? It doesn't give me a Bitcoin top or anything like that. I think you're playing with fire if you really want to try and time a Bitcoin top. I think time in the market beats timing the market, if that makes sense.
It does,
Right?
it does. Famous
Yeah.
investor quote that one, and yeah,
Yeah.
very
Yeah.
true. Do you use on-chain metrics? I use CryptoQuant and Glassnode.
Yeah,
Is that what
crypto
you use?
quant. I wouldn't really. The reason I don't like crypto quant is because their bias sways every day. Because I remember I was following that. I used to follow the guy on Twitter, and one day he used to post. One day it would be bullish, next day it would be bearish. Then next day it'd be bullish again. Then next day it'd be bearish. The reason why I like Glassnode is because they present you the data, and then they leave you to make your own assumptions from it.
Mm.
So that's why I like Glassnode. And Glassnode actually they release a newsletter every Monday at 5 p.m. Which is just Glassnode Insights, the week on chain. Just the previous gives you like the deep dive into what was going on chain the previous week. And I'd highly recommend everyone read that. It drops on a Monday, like I said, at 5 p.m. You can join their Telegram as well, which is where they kind of drop it first thing when it releases. And you can give it a read. But yeah, I would definitely do that.
Thanks. I didn't know that, and that is something I'm 100% going to check out.
Yeah.
Cool, right. Any questions from the floor, anybody, now that we've had some time to think? Feel free
Don't be
to.
shy, guys.
Yeah, don't be shy. Yeah. Great privilege to have Dilen on tonight. Dilen has got a wealth of experience on crypto. And yeah, any questions, feel free to put your hands up. I have a few more. If not, let me just see. Has
Yeah,
anybody put their hand
fire
up?
them away, man.
Okay. Nobody just yet from the floor, which is totally cool. Dilen, price prediction for Bitcoin, the end of the bull run. What's it going to be? 500K.
Oh man, I like to stay kind of conservative, man. I don't like these 300,000, 400,000 price target. Even though it could go there, we never know. You never know with Bitcoin, man. Like
Yeah.
if you really look at it, right, um, 200K from here, well, from the all-time high, 660K, is only a 3x. That's
Yeah.
nothing. That's nothing, right? If you look from March 2020 to 60K, what was that? That was a 20x, 20x.
March 2020 when it went down to 3K for about 2 minutes. It went to 3K for like 30 minutes. Yeah. So that would have been a 20x. Yeah. 60K.
Yeah, so from March to let's just say January, let's just say what March, whatever, March to March, a year, right? That was a 20x. So a 3x is nothing really, right? So yeah, my kind of I like to stay conservative. So I'm going to say anywhere between 150 to 200K. I'd be happy with that.
Cool. Brilliant. Question in the chat from Yash. Good evening, Yash. Good evening, Shavika, as well. Considering where we are on the business cycle based on what you showed, what would be the pie chart of your portfolio? I guess what Yash is asking there is what are the allocate. I know that you can't speak about the hedge funds portfolio, but you'll no doubt have a personal portfolio. If you feel comfortable, can you tell us roughly what the allocations of cash, altcoins, and bitcoins are? The three things that constitute a portfolio. So
Yeah.
for example, mine is at the minute. Mine is. Let me look at it right now, actually, just to get the ball rolling. We'll compare our portfolios. Let me just turn it into percentage holding. So at the minute, I'm actually 40% Bitcoin at the minute, which is
Mhm.
usually I'm like 90% altcoins. So that's like a record for me. 25% cash, and then I do the math. 35% altcoins. In fact, I think I'm slightly less than that. I'm 30 because I have some more cash that's not on this. So 40% Bitcoin, 40% cash, 30% altcoins. That's me at the minute.
Yeah, I don't, I'm not, I don't like to dive into allocate. I know you did. Sorry, sorry, bro, but I don't really like diving into
Let's
allocations.
go, man.
But it all just depends on your risk appetite, honestly. Like I said, with the business cycle thing that I showed, I don't want to scare any people. I don't want to be like a doomsday kind of guy and be like, oh, the market's going to crash, because I don't think the market's going to crash. Like I said, I'm bullish on Bitcoin, so I don't believe the market's going to crash too far. But if you want to be conservative or just kind of have a strong portfolio, I'd be siding with kind of what you did. I'd be like 50% Bitcoin. I'd be 30% ETH maybe, and then 20% altcoins. ETH you
Yeah.
can class as an altcoin, but I was having this discussion with a friend recently, and I was saying, when does ETH stop being referred to as an altcoin? Because the whole ecosystem it's building right now, like it's on a par with Bitcoin in terms of like its strength and influence in the market, right? And yeah, at the moment, I'd probably be weighting more towards ETH as a stronger allocation. I think ETH is more bullish than Bitcoin at the moment. Obviously, we had that EIP 1559 recently, which was tremendous for it. It didn't reduce the gas fees, unfortunately. A lot of people thought it was going to, but it didn't. Um, but it's obviously made it a deflationary asset, which is kind of puts it on par with Bitcoin. And like you said, like with that whole deflationary aspect, whenever a transaction is made, that kind of gas fee gets burnt, right? It just goes away. So the more you're seeing these transactions take place, like we're seeing right now with the NFTs, people are transacting with these through Ethereum, so they're having to pay a small gas fee on that as well. So the more you're seeing industries like NFTs and DeFi and things like that propping up, these are all built on Ethereum. So, and this is still early days. Remember, like Ethereum's got a long way to go. So yeah, bullish on ETH long term, especially if you look at the ETH BTC chart at the moment. That's showing that ETH is consolidating and coiling against Bitcoin at the moment. And it looks like it could be potentially breaking out in the months to come.
Cool, thanks for that. Hassan's got a question in the chat. On the topic of ETH, Hassan has asked what your personal price predictions for ETH could be this bull run.
Oh, yeah, I don't like I said.
Quick answer. I know you don't like to give them
I'm not one for predictions, but
predictions.
yeah, I think 10K is. I know everyone's been kind of floating that around, but it is a possibility. It could happen. One thing I saw recently was ETH actually lags Bitcoin by one cycle. So if you look at 2013 cycle Bitcoin, it topped out at around about $1,000, if I'm correct, right?
1200.
Yeah, 1,200 or something like that. I don't think ETH was around then. 2017 cycle, where did ETH top out? $1,000. Um, where did Bitcoin top out? 20K. This cycle, Bitcoin, is ETH going to top out around about 10, 20K? It could do. If you look at it, if you compare Bitcoin's 2017 run, sorry, with ETH currently this cycle, it's very similar. It's eerily similar. So yeah, I believe 10K ETH is a possibility. Don't quote me on that. It might not happen. Market could crash tomorrow. Have no idea. But yeah, ETH seems pretty strong at the moment.
Cool, thanks for that. And the second part of Hassan's question, what's your opinion on altcoins such as ADA?
Not a big fan, to be honest with you. It doesn't really have a working product. It's not a working blockchain.
Doesn't, does it? It's hype, I swear.
Yeah, it's hype.
Anyway,
Yeah.
yeah. And generally on altcoins, are you someone who likes to dabble with altcoins, or do you play it safe?
Yeah, yeah, I do like dabbling in altcoins. You'd be kind of silly not to, right, with the kind of gains that you do see out there. But obviously, manage your risk at the same time. Don't be 100% alts, because obviously, what happened in May 2021, just recently, you would have got burnt very badly because alts dropped by what 70-80% or something like that. So you would have got burnt pretty bad. So just manage your risk accordingly, and yeah, make sure you're not in too many shit coins.
Awesome advice. We've got a, hope that helped Hassan, by the way. We've got a question from
Another
RJ.
thing as well. Sorry, mate. Just
Yeah,
to kind
far
of
away, yeah.
just to piggyback on that point as well. Yeah, make sure you do your research into projects as well, because there's a lot of hacks that are going on nowadays. Certain projects seem too good to be true. Yeah, do your research. It's again, it's a cliche thing to say, but it's so important. Do your research, man. Like, don't just follow something because someone on Twitter said it was going to go to the moon, right? So do your research.
Fair enough, fair advice. Cool, we've got a question from RJ. I'm presuming that's Razvir. Good evening, Razvir. It's been a while since we spoke, mate. Hope you're good. Do you think Binance Coin? Oh, yeah, I love this question, by the way. This pops up. It's a little bit of a chestnut that pops up from time to time. Do you think Binance Coin should be in the conversation with Bitcoin and ETH as those two, as another project which is fundamental to the success of the space? Do you think it's
Yeah,
really
yeah,
that here?
yeah. Binance Coin's an interesting one, man. Yeah, it's done well throughout this cycle, very well actually. At the moment, I'm not too sure, especially with the concerns around Binance at the moment, the regulatory concerns around Binance. I would be more leaning towards FTT, which is FTX's token. And I don't know if you guys have been following it, but FTX and the owner of that, Sam Bankman-Fried, who's been kind of all over the kind of news networks and everything at the moment, FTX is booming as a platform right now, and they're really staking a claim to be a strong exchange in the space. I believe recently I just saw the futures volume. So the futures volume on the FTX platform has rapidly grown. Let me try and get the figure for you.
Yeah, it'd be interesting to see that.
Yeah,
Binance
yeah,
recently in the UK, you can't actually trade on 125 leverage anymore. You can only trade max 20.
yeah. That's the same with FTX as well. They've lowered it.
Oh.
What am I looking at?
I mean, they shouldn't. We're not technically allowed to do it at all in the UK, but they've kind of Binance have wriggled through the regulatory framework by, well, they're based in Germany, so they can avoid adhering to the CFD regulations because of that.
Mm, yeah.
I don't know about FTX.
Yeah, I mean, I'm not too sure, but I know they both definitely they released the news at the same time. They released the news at the same time that they were going to drop it from 100x to, and I think it's great because at the time when the crash happened, there was a lot of leverage in the system, and a lot of why we saw that crash was because people were over leveraged. I remember when we dipped. I was sat right here on that day in May when everything crashed, and I went away from my laptop. I had my alert set on Bitcoin if it was going to hit 35k, 30k, and I was like, right, I'm going to go and get some lunch. And I was sat at the table having my lunch, and all my alerts popped off on my phone, and I was like, fuck's sake, like the market just crashed. And people were buying the dip with leverage, and that's scary, man. Like you at that point in time when you've seen a 40-50% correction, you want to be buying the dip with spot, right? You want to just be buying the dip with USD or USDT or whatever. You don't want to be buying the dip with leverage. And that just shows how much emotion and greed was in the market at that time, right? So yeah, I think it's a great thing that Binance and FTX have done to lower it to 20x. Still a lot, 20x leverage. People don't generally need that, or you shouldn't really need that. But yeah, it's a good move. It's a right step in the right direction.
For anybody who's unsure what leverage is, basically it's when you borrow money to
Yeah,
magnify your position. With leverage, a really interesting way of working on, and what happens is if the price moves a sufficient amount against you, you get liquidated, so you lose your whole position because you
exactly.
have to pay back. There has to be enough. Well, they have to pull your trade sooner. They have to pull your trade sooner so that they can actually make some money on it effectively. Because if you're constantly borrowing money, this is the take back, I suppose. This is the kickback at the other end. If you take 125 leverage, the way you can work out at what percentage you will get liquidated, the percentage move away from your entry price, is if you take 100 and divide it by your leverage, then you can calculate the percentage at which the price has to move against you before your position gets liquidated. So if you're trading on 125 leverage, do the math. 100 divided by 125, I think it's like 0.7, 0.8. If the price moves 0.7 of a percent against you, you'll lose all your money in that trade. And that can be 100 grand, that can be 100, a million, that can be anything. And what they do as well, if it moves against you too rapidly, they'll take your funds from your spot account too, which is very rare. But what I'm saying is wait till you've had a bit of practice before you trade on leverage, and just be very careful with
Yes,
it. But you can
100%.
make very good gains.
Yeah,
It's
yeah,
all it's kind of like it kind of adds another dimension to the equation, because you have
yeah,
to. It's not just your entry, your stop loss and your profit taking targets. You have to modify your leverage too. So it's like another extra thing to consider in the equation. But just something interesting I'll throw in there. It can be very fun when it works for you.
yeah.
Cool. And oh, I'm sorry, it wasn't Rajveer, it was Rishi. I beg your pardon, Rishi. And thank you. Rishi has kindly said, thank you for your time both to just watch you guys have a chat. That is really kind, Rishi. Thank you so much for that. We've had a lot of fun presenting this as well.
Yes.
We
Sorry,
have,
mate. Just to go back to that FTX thing. So I just finally
yeah, go
found the
on.
number.
Yeah.
I finally found the number. So from the end of June until today, so FTX's market share in the futures market, which is obviously leveraged, like James was just talking about. So from the end of June, it was at 9%. It's actually grown to 16% now. So it's just behind Binance in top spot. So that's yeah, it's making a stamp. And I'm not sure if you guys seen it, but it's been like buying up sponsorship deals with like gaming within the gaming world. It's sponsoring like a stadium out in the US. I'm not even saying like I think it's the Staples Center or something like, I can't remember what stadium it is, but it's now sponsored by FTX, that stadium in the US. So they're making some interesting moves. And instead of Binance coin, I'd probably be betting a little bit more on FTT at the moment.
Okay, awesome. Food for thought. That's cool. Amina's popped in with a question. Good evening, Amina. I hope you're well. Is now a good time to buy ETH? We think so, right?
Um, well, if you're talking right now, it would depends what kind of time horizon you have, right? If you're talking like a day, then I don't know. But if you're talking like a couple of years, then yeah,
Yeah, yeah. Time frame is so important. Good point.
time frame.
Cool. Rishi has jumped in again. Purely wild opinion. How does the crypto space look in 10 years for
Oh,
you?
that's a really good question. That's a really good question. Um, I think Bitcoin. The question is whether Bitcoin is going to be the number one by market cap still in 10 years' time, and people generally kind of throw that out a lot, and or whether it's going to be ETH. That's number one. I don't know. Um, I don't know. I feel like there's going to be a lot of these, like in different industries. Like you've got DeFi and NFTs. There's going to be like a million other of these industries popping up. I feel like DeFi is taking away a lot of attention from traditional finance into like, because on DeFi you're getting like yields of like 100% like APY like a year. It's insane. And on like bond yields, like I was saying, you get like a 1.3% return over 10 years, which is ridiculous. So it's taking capital away from the traditional markets and bringing it into the crypto sphere. Still, I think right now we're still so early. Like a lot of people in the traditional space don't really understand crypto yet, but it's happening. It's slowly happening. I think Bitcoin in 10 years' time moves like the equity market. I don't think it moves in these 4 year cycles anymore. That's just my personal opinion. I think it moves just like generally in a straight line upwards, and it's just going to have these short, sharp corrections along the way. Because at that time, you got to think the majority of the Bitcoin is going to be picked up by these long-term holders, and they're not going to be selling. People like MicroStrategy, Michael Saylor ain't selling for the next decade or 2 decades.
Cool. Awesome. Thank you for that. And Beju has said, cheers, James and Dylan, for that. Crazy Alpha. So much information to take away. Catch you all soon. You're welcome, Beju. Hassan, BlockFi recently got hit by a cease and desist on interest accounts. Was that what happened? I thought it was more a we're
Yeah, something
watching.
like that. Something like that happened. Yeah, yeah. I did see that.
They might
Yeah, it
have
was a New
hit.
Jersey thing. It
Go
was a New
on.
Jersey thing, but applied worldwide. So they basically said they can't, like, I guess, allow any more new interest accounts to be created. And then BlockFi got an extension. They got another extension, and the reasoning was that essentially it's going to affect the current clientele. And in the meantime, they're trying to convince those guys in New Jersey that they're not really dealing in securities and stuff like that, and their product is not security based. So that's where we are right now. But my question, I guess, deals with, I mean, where is this field going at the moment? Is there more scope for this? Because, like, if they start clamping down on this, what happens?
Yeah, it's a good. To be honest, I don't have the honest answer for you. To be honest with you, I don't know what's going to happen. I think what's going on right now is regulators are just poking around everywhere. Like with Binance, you're seeing it right now as well, right? BlockFi is probably just another one. I think they're just poking around everywhere, seeing what's going on, investigating what they can. So yeah, I don't see anything drastic happening from it. It's just regulators just getting a bit nosy and trying to figure out things.
Okay, cool. Yeah, no, we'll have to just watch that one, Hassan. Bit of a developing situation.
Yeah.
I'm not taking my funds off BlockFi personally, to be honest.
What's the yield that you get on BlockFi?
It was 8.5. Now it was 8.8 actually, and now it's 7.5.
That's quite good.
But BlockFi, the reason I like BlockFi is because it's backed by Gemini. There is one called I've even seen. So BlockFi is of course CFI. It's not technically DeFi. I've seen higher yields in CFI. There's one called Nexo Finance, which will give you 12% on your British pounds.
Yeah. I've
which
seen that
is,
as well.
but it's not backed by a big exchange, so it's
You
from the
can get
point.
similar returns on your USDT as well, like 11-12% on some, on like I think
Yeah, Nexo.
Binance. Yeah, is it Nexo? Yeah, okay. I think you can do it on Binance as well. The Binance have like a feature, the Binance Vault or something like that. I don't know what it is, but you can get like a nice nice yield on USDT.
I need to check that out. I saw on what platform was it on? It was Bancor. I saw 50% for USDC.
Yeah,
It
yeah,
was yield mining rather than yield farming. So they give you like 20% APY USDC, and then they give you like 30% of the yield in BAL token. It was only a temporary thing, but 50% a year is crazy on a stable
yeah.
coin. I'm a massive fan of Pancake Swap, 100% APY. Yeah, it's not a stable coin, but it's pretty cool. Cool. Right. Anyway, we've got a question for AM from AM. I'm unsure who that is, but good evening, AM. Oh, it's Mohammed. Mohammed, how are you, mate? Dylan, this one is for you. Could you summarize how your hedge funds works for clients?
Doubt it. Nah.
I tell you what, Mohammed. I tell you what. Reach out to me afterwards, and maybe we'll talk about that. But yeah, we'll keep that off this chat for now. Right, cool. Anyway, brilliant. Thank you so much for your time tonight, Dylan, that was tremendous. Everybody
Appreciate it,
learned
man.
loads. That was an awesome presentation, and it did a lot of the things you said were things that complemented what I said in webinar
Very good.
number 3, which is
Good stuff.
which is really, really, really cool. So it just built on that very nicely.
Yeah.
Guys, what we're going to do, we're going to wrap up in just a moment, but I just wanted to mention something super, super, super quick. And that is for the people that have completed the course already. So there will be lots of you who are on the course tonight, who are on the Access to Bitcoin program, and you'll be about halfway through or just beginning, even some of you. There will be some of you who have completed all of the content. You're a member of the Access Bitcoin community indefinitely. It's your community. There's going to be content like this for the foreseeable future, for as long as while I still continue to be into crypto, which I don't plan on stopping anytime soon. It's going to be a lifelong thing for me, crypto for life. I have created, or I have been looking at what I can do to serve you all, to create something else which will be of interest to you as dentists who wish to broaden their knowledge in the finance world. And I've been putting a little something together. Let me just go ahead and share my screen. We have, first of all, just wanted to say, like I was saying a second ago, congratulations to everybody on completing the course. And I suppose for me, what happens next is, where do we go from here? What's on the horizon? How can we create something which complements the knowledge that we've given out on the Access to Bitcoin course, and also builds everybody up even more? Because whilst we've talked about finance, whilst we've talked about the broader realm of finance, there's still so much more that we could discuss in that field, particularly if we want to have a diversified portfolio beyond crypto. So what I have done, what I have created, and I'll be reaching out to a lot of you about this very, very soon, year-long mastermind group. This is what I'm formulating, and this is what I've created, and this is the model that I've decided upon. And I'd love to hear your thoughts, and I'll be reaching out to everybody about this at some point. Year-long mastermind group. This starts in 2022. We deal with all aspects of finance, not just crypto. So you can build that portfolio, which is not just a crypto-based one, but one that's diversified and broadened beyond that. We're going to have experts from pretty much every field of dental finance on there. A lot of experts that you'll see on the group, familiar faces, some really big names who will be guest speakers who will be coming along to this. The benefit of having a guest speaker speak to a room full, what I'm aiming to do, I want to keep this select to a group of about 20 people or so. If we are able to get an IFA to speak to 20 people, rather than have the same conversation 20 times with each one of us as individuals, you can see how there's a massive benefit there from an economy of scale perspective in terms of the price per head for that information. The information is the same, the value is the same, but it's spread out amongst 20 people. There's a huge, huge, huge bit of potential there to capitalize on that and make that so much more effective, yet still getting the same value. So that was the model that I arrived upon. That was the idea that I had that allowed me to formulate this. And it's all about giving as much value as we can to the people that come on the course, just like we have done for Access to Bitcoin. Accountability programs, mentorship on how to invest, and it's designed to give you a comprehensive and total understanding of money, not just in the crypto world, but more broadly beyond that. This is something that I have put together, and I've arrived upon the name of Total Finance for Dentists, and this is something that's starting in 2022. Those people who have finished the course already, I will be reaching out to you for your one-to-one meeting, your second one-to-one meeting, and I'll be talking to you about that then. But just giving you all a heads up, something to look forward to, something exciting. And this is going to be a huge thing for dentists who invest, for dentists in the UK who want to learn more about finance. Absolutely massive. And this, to my knowledge, this program is totally unique. And from my point of view, you know, being able to bring this to you is a pleasure. It's an honor, something that I'm excited for. And yeah, just letting you know that that's something to look forward to. There'll be details released on the group at some point. This is exclusively for people who have already finished the course already. And this is the next level, so to speak. So something to look forward to. Let me just jump out of my screen sharing. Okay, good to see everybody tonight. Thank you so, so much for coming along. I will be reaching out to each one of you that's finished the course over the next few weeks regarding the next level. So something to look forward to. I'll be drop you a message in your inbox, and we can get on Facebook, and we can get that booked in. Good to see everybody tonight. We've got a few thank yous flowing in. We've got a thank you from, who else have we got? AM, you're welcome. Mohammed, Liam, Hasnian, thank you Hasnian, thank you Liam, thank you Sarjet, thank you Debbie, thank you Gregor, my friend, and thank you Vabe as well. Awesome. Thank you so much everybody for coming along tonight. Absolute gold dust that. You're welcome Jake as well. He just slipped in there at the final whistle. Thank you for Dilen. For giving up his time this evening. It's been my pleasure to host this. Plenty more bonus content to come on the Access to Bitcoin group. You will see that over the next few days. And as I say, it's been my pleasure to host this evening. I shall see you all once more very, very, very soon. I'll see you all later. Goodbye.
Cheers, mate.
See you later, Dylan.